Hotter than expected job support, that was somewhat surprising. What was your read?
Oh, it was very hot, and it was hot across the board. And I think the particular data point that the Fed is going to zero in on was wage growth on a month-to-month basis. It was double expectations at 0.6%, and year on year we're above 5%. And they're not going to like that number. But the market is still anticipating that there'll be a little bit of a pivot where they'll stop the 75 basis points and switch to 50 basis points in December. But I think the market may start shifting that maybe we'll go a little bit higher in February, not 25.50, and certainly that they're going to probably stay higher for longer.
So 50 basis points at the December meeting. Why 50 if we just got a better than expected job support? Doesn't that push the Fed to say, no, let's stick to 75? Or does it really come down to the CPI report, which comes out next week?
Well, I think it's a number of things that they're looking at. Certainly, housing data has been softening quite a bit. If you look at commodity prices, particularly like the CRB index, you're seeing a lot of commodities roll over. CPI does look like it's already peaked and rolled over. So they've been raising quite a bit, probably the most aggressive of my entire career. And they're going to want to start seeing what kind of an impact these rate hikes are having because of the long lag. You know, the lag could be 12 months or more. So I think they'll definitely do 50. I don't think they'll do 75, but I think next year they're going to be a little bit higher than what the market was anticipating.
Meantime, we're watching Chinese tech stocks move sharply higher. This has been a big trade over the last 2 weeks, Marianne. I'm not sure how closely you've been watching it, but just this idea that China is starting to reopen, the government may be, in a way, bending to those protesters. Your thoughts on how that impacts the global economy?
Sure. Well, if you look at just China alone, and you look at valuations, it's the cheapest market. It's trading in the nine times, PE multiple. It's, very, very oversold. So I'm not surprised to actually see a bounce. And I think one of the surprises that we'll have in 2023, if we wind up having the Fed actually begin to pivot and the market sense that, the emerging markets actually might be the biggest outperformer in terms of returns. So I'm not surprised to see this. Now, there's a lot of geopolitical risk. But we may actually in 2023 have markets that are surprisingly stronger than people are anticipating.
Biggest event you'll be watching this week. We get durable good orders. We also get manufacturing data later this week. Marianne, what's on your radar?
Well, definitely durable goods. Anything to do with pricing, the Fed is going to definitely zero in on to just see where we are in pricing. Now, in terms of the PMIs in manufacturing, we finally broke below 50, and we traded at 49, which indicates, a recession. So when we go to the services data, it's going to be very interesting to see that particular data and how strong, because the goods market has been weak, but the service market has been strong. And as we know, the Fed is trying to slow inflation. One of the ways to do that is to slow everything down. And so they're going to want services down as well. So that's something that I'm particularly paying attention to.